The term bond vigilante sounds dramatic, almost like something out of a noir film or a comic book, but in the world of finance, these so-called vigilantes are very real, and their influence is far-reaching. They operate in the shadows of the global economy, often unseen by the public, yet their actions can send shockwaves through entire nations. Their power is undeniable. They can shake governments and unsettle markets without ever firing a shot or making a public statement. Instead, their weapon is money, and their battleground is the bond market. These vigilantes aren't secret agents or shadowy figures in back alleys. They're investors, sometimes individuals, sometimes massive institutions, who buy and sell government bonds, acting as an unofficial check on reckless government spending and fiscal mismanagement. When governments need money, they borrow by issuing bonds. Investors lend them cash, expecting to be repaid with interest in the future. It's a relationship built on trust and confidence in a country's ability to manage its finances. But if investors start to doubt a government's fiscal responsibility, maybe due to rising debt, political turmoil, or risky economic policies, they can quickly lose faith and begin selling off those bonds. This mass selling isn't some grand conspiracy. It's a collective, almost instinctive reaction to perceived risk, a way for investors to protect themselves from potential losses. The result? Bond prices tumble, yields surge, and suddenly, governments find it much more expensive to borrow money. It's a clear, unmistakable warning from the market itself, a signal that fiscal discipline is non-negotiable. The vigilante's message is simple but powerful. Manage your finances wisely or be prepared to pay the price. In the end, the market always demands accountability. The influence of bond vigilantes is both powerful and straightforward, yet its consequences can be far-reaching. When bond prices fall, yields automatically rise. This is a fundamental rule of the bond market that shapes the cost of borrowing. For instance, imagine a £1,000 government bond that pays £30 a year in interest. If investors lose confidence and the bond's price drops, the yield rises, making it more expensive for the government to borrow money in the future. Higher yields force governments to rethink their spending plans, reconsider expensive projects, or even delay popular tax cuts as the cost of financing these decisions increases. But the impact of rising yields doesn't end with government budgets. Government bond yields serve as the benchmark for nearly all borrowing in the economy. When yields climb, interest rates for mortgages, car loans, and business loans also increase, making it more expensive for ordinary people and companies to borrow money. Suddenly, families find their monthly payments rising, and small businesses struggle with higher costs, all because investors are signaling their disapproval of government policy. The actions of these vigilantes send shockwaves through the entire economy, creating a ripple effect that touches everyone, from homeowners to entrepreneurs. Their protest isn't just about numbers on a screen, it's a direct and public challenge to the decisions made by those in power. In 2025, bond vigilantes made headlines, shaking the very foundations of global finance. These investors, often overlooked, suddenly became the main story as their actions sent shockwaves through markets and governments alike. The Trump administration's aggressive tariffs on China spooked investors, who feared not just economic fallout, but also a surge in inflation and a slowdown in global growth. The escalating trade war left markets on edge, with uncertainty spreading rapidly. In response, investors dumped U.S. Treasury bonds at an unprecedented pace, causing yields to spike and borrowing costs to soar for businesses and consumers. The stock market tumbled, the dollar weakened, and panic began to ripple through financial institutions. The administration faced mounting pressure from all sides, Wall Street, Main Street, and even international partners, demanding a change in course to restore stability. Even President Trump, known for his confidence, admitted the market was tricky and people were queasy, acknowledging the deep anxiety gripping investors and the public. Within days, the White House was forced to delay the tariffs, a clear and public victory for the bond vigilantes, who had flexed their collective muscle without ever casting a single vote. Investors and traders celebrated the sudden policy reversal, relieved that their message had been heard loud and clear at the highest levels of government. The episode proved that even the world's most powerful superpowers ultimately answer to the bond market, and that investor confidence can shape the course of history. Bond vigilantes aren't just a distant force, they affect your daily life. When they drive up yields, your mortgage, car loan, and credit card rates can all rise. Businesses borrow less, hire fewer people, and economic growth slows. The vigilantes can even override election promises by making ambitious policies too expensive. Their verdict creates a constant tension between democracy and market discipline. In a global economy, governments are judged by both voters and investors. Understanding these shadowy enforcers helps explain why your wallet feels the impact of decisions made far from home.